Welcome, everyone. I am absolutely thrilled to jump into this explainer with you today. We are breaking down Shopify's truly explosive second quarter 2026 earnings report from August 5th. We've got a ton of fascinating data to unpack, and we're going to see exactly how Shopify is literally rewriting the rules of e-commerce. Let's get right into it.
To give you a real sense of the sheer scale we're dealing with here, Shopify's president, Harley Finkelstein, flat out called this a monster quarter. And you know what? The numbers absolutely back that up. I mean, we're looking at a massive $3.58 billion in revenue. That's a staggering 34% year-over-year growth. They actually blew past Wall Street estimates by $130 million. And free cash flow? That came in at $654 million, which gives them a phenomenal 18% margin. It's just wild.
So naturally, because of those blowout numbers, the market reaction was completely explosive. Shares surged nearly 18% in a single day, climbing from around $123 to over $145. This massive jump essentially wiped out a huge chunk of the company's post-Q1 slump. It sent a very clear signal to the market. Shopify's deep, aggressive pivot into artificial intelligence, yeah, it's paying off, big time, in real, tangible dollars.
Okay, so here's our roadmap for today's explainer. First, enter Agentic commerce. Second, Sidekick AI in action. Third, enterprise and merchant growth. And finally, Wall Street's verdict.
All right, part one, enter Agentic commerce.
The absolute crucial paradigm shift we need to talk about here is agentic commerce. What does that mean? Well, we're talking about AI-driven shopping experiences where software agents, not just human beings scrolling and clicking, are actually out there discovering products and completing transactions on their own. Shopify's leadership basically believes it doesn't really matter whether a purchase is driven by a person or a bot, as long as their platform processes it. And the real kicker? These agentic transactions carry the exact same economics as traditional online store transactions. No separate fees, no weird revenue splits. The whole shebang is the same.
Harley Finkelstein really hammered home their dedication to this tech with a pretty bold claim. He actually said they are probably the most, quote, AI-pilled company in the world. And honestly, the early results from this obsession are just striking. Check this out. AI-driven traffic and orders to Shopify stores literally tripled year over year. Tripled. But even more fascinating than that, 75% of AI-attributed purchases in Q2 came from completely outside the platform's top 100 product categories. Think about what that means. The AI isn't just taking the easy route and lazily recommending bestsellers. It's actively playing matchmaker, connecting very specific buyer intent with highly specialized niche products.
Now, all of this relies on Shopify's structured catalog, and that right there is a massive competitive moat. Because Shopify's data layer is incredibly organized across more than 1 billion products, AI searches on their platform convert at twice the rate of traditional internet searches. You know, the ones that just rely on messy, scraped web data. Having this highly structured product data, that's going to be one of their absolute most important assets moving forward.
Moving right along, part two, Sidekick AI in action.
Right at the very heart of this whole AI push is Sidekick. That's Shopify's conversational AI business assistant. Get this, in the second quarter alone, merchants had nearly 34 million conversations with it. 34 million! Daily active usage of the tool just skyrocketed, up 3.6 times year over year. And we're not just talking about simple chatbots here. Finkelstein pointed out that onboarding guidance from Sidekick directly drove an 8% increase in new merchants successfully reaching 5 orders within their first 15 days. It's literally helping them make money faster.
And this adoption rate is translating directly into hard infrastructure. Let's look at the numbers. In Q1, merchants used Sidekick to build about 12,000 custom apps. Fast forward to Q2, that number exploded to over 36,000 custom apps built in just one single quarter. So merchants aren't just poking around testing the AI for fun, they are actively putting it to work to build essential custom infrastructure for their businesses.
This actually perfectly sets up a great anecdote Finkelstein shared on the earnings call. He was talking about meeting with really large merchants, the kind of companies that traditionally have to sit around waiting for huge data teams to run basic queries. Well, now, if they want to know the exact city most of their customers are buying from, they don't submit a support ticket and wait a week. They literally just ask Sidekick and get the data instantly. It's a total game changer. And Shopify is pulling this off efficiently by using those big, expensive frontier AI models to train smaller, specialized models. That makes answering these everyday merchant data queries incredibly fast and, crucially, highly cost-effective.
All right, part 3, enterprise and merchant growth.
Because beyond all the incredible AI hype, the core financial engine is firing on all cylinders. Now, what's really interesting about breaking down where this money is actually coming from is that it reveals a pretty fascinating split. Merchant Solutions, which covers things like payments and transaction-related income, grew by an unbelievable 37% year-over-year, hitting $2.78 billion. Meanwhile, the subscription solution side also saw really solid growth, up 22% to $802 million. So, what does that tell us? It tells us that merchants aren't just paying a monthly fee to use the platform, they are out there transacting heavily on it. And a lot of those heavy transactions are increasingly coming from absolutely massive players. Just look at the names they added in this single quarter. Global heavyweights like Balmain, Guess, Avon, ELF Cosmetics, Claire's, Burton, and Suit Supply. By continuously reeling in these massive enterprise whales, Shopify now powers over 14% of the entire US e-commerce market. To put that into perspective, they've captured nearly half of all incremental e-commerce dollars in the US since the start of 2025. Just let that sink in for a second. So, obviously, all this enterprise adoption drove some truly staggering gross merchandise volume, or GMV, across a bunch of different categories. We're talking B2B GMV surging by 76%, Shop Pay up 53%, International grew 37%, and even their offline segment climbed 32%. Put all of that together, and it drove total GMV to a mind-boggling $116 billion. And remember, this is now the 5th consecutive quarter of GMV growth sitting above 30%. This isn't a one-off fluke, folks. This is a sustained, powerful trend. Which brings us nicely to profitability. Gross profit jumped 31% to $1.71 billion. And amazingly, operating expenses actually fell to 34% of revenue. So because they have this consistent operating cash flow and a really healthy balance sheet built for the long haul, the board decided to expand their share repurchase authorization. They added $3 billion to it, bringing the total program up to a whopping $5 billion. As their CFO Jeff Hopmeister put it, these strong results essentially give them the freedom to aggressively return capital to shareholders, all while still heavily investing in building out new products. It's a win-win.
Okay, moving to part 4, Wall Street's verdict. Let's see how the big players are digesting this.
As you might expect, the response from top financial analysts has been overwhelmingly bullish. Following the report, 52 analysts polled by S&P Global gave Shopify stock a consensus rating of buy, with an average price target sitting at $167.89. Several major firms just aggressively bumped up their targets. You've got JP Morgan going up to $185, Truist up to $180, Evercore at $175, and Scotiabank pushing all the way up to $200. Wall Street is very clearly loving the growth metrics we just walked through.
However, to be totally fair and look at this neutrally, not every single analyst was perfectly bullish. On August 17th, Phillip Securities actually downgraded Shopify from buy to accumulate. Why? Well, their main reasoning was that margins actually saw a slight decline, about 90 basis points or 0.9% year-over-year. This was partly due to a shift toward lower-margin merchant solutions, but also crucially because of the higher costs associated with running all these AI and large language models. Though it's pretty interesting to note that
So, looking ahead, here is the specific timeline of catalysts that investors are going to be watching like a hawk. In November, we've got Q3 earnings coming up, where Shopify is already guiding for revenue growth in the low 30s% range. Then, of course, we roll right into December to monitor the all-important massive holiday GMV. And ongoing throughout the entire year, the market is going to be intensely tracking the continued rollout of these agentic storefronts and the scaling of that wildly successful B2B segment we talked about.
Which leaves us with a final, pretty provocative thought to wrap up our explainer today. When you look at their massive investments in Sidekick, this structured billion product catalog, and software that literally completes transactions for you, we really have to ask ourselves, is the future of commerce built by people or by agents? Shopify is betting heavily on the agents, and right now, the numbers suggest they might be absolutely spot on. Thank you so much for joining me for this deep dive into the data. I really hope this gave you a clear, structured view of how the e-commerce landscape is shifting beneath our feet. Catch you next time.